Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Lenovo Group Limited, latest report. Lenovo Group Limited offers a wide range of technology products and services across various segments. At its core, the company provides commercial and consumer personal computers, including laptops, desktops, tablets, monitors, and accessories. It also manufactures and distributes IT products, such as computer hardware and peripheral equipment. In addition to product sales, Lenovo offers a variety of services, including consulting, deployment, managed support, security services, and data management. The company's Solutions and Services Group segment provides business planning, management, supply chain, finance and accounting, administration support, procurement agency, and intellectual property services. Furthermore, Lenovo is involved in the retail and service business for consumer electronic products and related digital services. It also develops software and applications, as well as communications hardware and software through its development, ownership, licensing, and sale of such products. The company operates globally with a presence in China, the Asia-Pacific, Europe, the Middle East, Africa, and the Americas. Overall, Lenovo's business encompasses a broad spectrum of technology products and services, positioning it as a leading player in the industry. Lenovo Group's stock price has experienced a substantial drop of over 26.95% in the past year due to several key events and factors. One major contributor was the company's third-quarter fiscal year 2025/26 earnings report, which revealed a decline in net profit attributable to shareholders by 21.21%. This significant decrease in profitability had an immediate impact on investor sentiment, causing the stock price to drop by approximately 4.7% to 6.3%. Another crucial factor was the rising memory chip costs, which increased by 40% to 50% for Lenovo over the last quarter. The company's CEO, Yang Yuanqing, warned that this memory crunch would affect the global hardware industry for the remainder of the year, putting pressure on profit margins across the electronics sector. Additionally, Lenovo undertook a strategic restructuring of its Infrastructure Solutions Group, ISG business, resulting in one-time restructuring charges of $285 million. Although revenue saw an 18% year-on-year increase to a record $22.2 billion in the same quarter, this positive top-line growth was overshadowed by the profit decline and restructuring costs. These factors collectively contributed to the significant year-on-year decrease in Lenovo Group's stock price, highlighting concerns about the company's profitability and ability to navigate rising memory chip costs. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified from the recent financial performance of various business groups and geographies. On the growth side, AI-related revenues have seen a significant increase of 72% year-on-year, driven by strong performances from all three business groups, ISG, SSG, and IDG. The record high revenue for ISG, $5.2 billion, and SSG, along with double-digit year-on-year growth in key sales geographies for smartphones, have contributed to the overall revenue growth. The robust pipeline of $15.5 billion for AI servers, an expanding revenue mix of managed services and project and solutions in SSG are also significant drivers of revenue growth. Additionally, the adoption of premium attached services and resilient penetration rate in support services, as well as the momentum across DAS and IaaS offerings from TrueScale, have contributed to the revenue growth. On the decline side, the ISG segment has seen a 30.4% decrease in revenue, while the Asia-Pacific (AP) geography has experienced a 23.1% decrease in revenue. These declines are significant and need to be addressed by the management to prevent further erosion of revenue. Net income experienced a mixed trend over the past quarter. In Q3, it decreased by 8% year-over-year, resulting in a net loss of $147 million. However, for the first 9 months, net income increased by 17% year-over-year, reaching approximately $546 million. Profit margins also underwent significant changes. The gross profit margin declined by 0.6 percentage points to 15.1% in Q3 and further decreased by 0.7 percentage points to 15% in the 3 months ended December 31, 2025. On the other hand, operating profit margin increased substantially, rising by 23 percentage points to 38% in Q3. The reasons behind these changes are multifaceted. Restructuring charges, employee benefit costs, and advertising expenses contributed to the decline in net income and gross profit margins. However, operating leverage, efficiency gains, and higher revenue from premium products and services offerings helped boost operating profit margin. The strong growth of the Solutions and Services Group, SSG, with an 18% year-over-year increase, also played a significant role in improving overall performance. The company's financial performance indicates a positive trend in operating cash flow. The data from various sections of the report confirms that the company is generating significant amounts of cash from its core business activities. For the 9-month period ending December 31, 2025, the net cash generated from operating activities was consistently high across different reports. On page 21, it was reported to be $3,713,874, while on page 29, it was stated to be $1,493,711 for both the 3- and 9-month periods. Additionally, page 37 also supported this conclusion, with a net cash generated from operations of $4,539,895. These figures demonstrate that the company is successfully converting its earnings into operating cash flow, indicating a strong financial position. The consistent generation of positive operating cash flow suggests that the company's business model is efficient and profitable, allowing it to generate significant amounts of cash from its core activities. The company's debt level has undergone significant changes over the past period. Total liabilities have increased from $37,571 million to $44,786 million, indicating a rise in overall debt. This increase is largely driven by short-term loans, which have surged from $65.4 million to $195.7 million. While non-current liabilities have also seen an uptick, the growth rate is relatively modest. In terms of interest expenses, there are mixed signals. On one hand, adjusted net finance costs have declined year-on-year, suggesting a reduction in overall financing costs. However, interest expenses have increased due to the issuance of new notes with higher interest rates. Furthermore, changes in derivative financial liabilities imply an increase in interest expenses. Nevertheless, interest expenses did decrease by $137,630, 24.2%, for $9,000,2025 compared to $9,000,2024, indicating a temporary dip in financing costs. The company's performance varied across different segments and regions in the recent period. On a positive note, the Solutions and Services Group, SSG, witnessed an impressive 18% year-on-year revenue growth, while Asia-Pacific, excluding China and Americas, recorded 8% and 25% year-on-year revenue growth respectively. The IDG segment also performed well due to strong commercial demand and market share gains. Additionally, ISG demonstrated robust performance with solid execution in enterprise and SMB segments, as well as sustained demand for AI servers, HPC, and storage. However, the company faced challenges in certain regions. China's revenue growth was only 15% year-on-year, despite supply chain pressures. This relatively lower growth rate compared to other regions indicates that the company needs to focus on improving its performance in this key market. Overall, while there were pockets of strength across different segments and regions, the company still has opportunities for improvement in certain areas. Management is optimistic about the company's future prospects. They expect to maintain global leadership through innovation and strategic execution. The company plans to accelerate its return to profitability in the next fiscal year, achieve annualized net savings, and capitalize on long-term growth opportunities. The AI infrastructure market is expected to triple by 2028, presenting a significant opportunity for the company. To prepare for this growth, management has implemented restructuring actions to optimize the portfolio, upskill the workforce, and enhance productivity. These efforts are aimed at improving operating results rather than focusing on one-time or non-recurring events. In addition to these strategic initiatives, management is investing in patent and technology, assets under construction, equipment held for lease, and plant and machinery, which has resulted in higher capital expenditure. However, the company aims to improve balance sheet efficiency through factoring arrangements, indicating a focus on financial optimization. Overall, management's outlook suggests a commitment to innovation, growth, and operational excellence. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts each year, with $612,512 paid in the first 9 months of 2025 and $608,351 in the same period for 2024. In addition to paying dividends, the company has also engaged in share buyback activities. While the numbers are negative due to the accounting treatment of share buybacks as a reduction in equity, they indicate that the company is actively repurchasing its own shares from the market. In 2025, the company spent $404,342 on share buybacks and $246,422 in 2024. Concerns about inventory buildup are emerging due to a significant increase in raw materials and work in progress over the past year. According to financial records, there was an increase of $994,303 from March 31, 2025 to December 31, 2025. Furthermore, finished goods also saw a notable rise of $220,261 during this period. These numbers suggest that inventory levels may be building up, potentially leading to supply chain disruptions and other operational challenges. That concludes the financial summary for Lenovo Group Limited. Feel free to comment below, and I will be happy to answer them when possible.